Hello, I'm Nathan Kubik, and thank you for joining us for the first quarter's Transform Wealth Capital Markets Review. I hope you are all doing well. After a challenging 2022, we have had an interesting start to the year and we have a lot to discuss. Today, we will be discussing the changes and key influencing factors we are seeing within the markets, as well as what we believe to be the most important moving pieces going forward. After a discussion on the potential impacts from those pieces, we'll expand upon how we're positioned from an investment standpoint in a number of our strategies. So let's get started. Inflation remains the most critical factor in the markets. The Fed raised rates in February and March, bringing borrowing costs to their highest point since 2007. Inflation does appear to be slowing, with the most recent CPI and PPI showing improvements, but not at a dramatic level. The higher inflation did take a toll on corporate earnings, but so far, corporations are weathering the increased costs and are making moves to cut costs and create efficiencies. While we are encouraged by the data we are seeing, it's still early and there's a ways to go. We are not completely out of the woods yet, and there are still prevalent risks. To that end, in each of our strategies, we are positioned with this in mind. In this chart, we consider inflation on a year-over-year basis. As you can see, the Consumer Price Index, a measure of inflation, is moving back down. We remain at elevated levels, and the Fed is dedicated to bringing it down further. It is important to understand that the actions taken by the Fed do have a lag effect, and it takes time for their actions to show their impact. This is the tightrope the Fed is walking, because the exact impact of their actions takes time to be seen. And if they raise rates too far, economic risk could become a factor. There is also the risk of unforeseen consequences, as we saw within the banking subsector this past quarter. To understand what happened with Silicon Valley Bank and some of the other banks, let's revisit how bonds are priced. They're basically priced by a time value money equation, and as rates rise, those fixed future coupon payments and principal payments are discounted at a greater rate, lowering their present value or price. Thus, the longer the duration or lifespan of the bond, the more impact on the present value. Remember that we recognize this risk and had been intentionally shorter in duration in each of our bond strategies. To illustrate the impact of longer duration bonds, let's take a look at this chart. Here, we consider the interest rate hikes done by the Fed compared to the long duration 30-year Treasury bonds. As you can see, longer bonds had a meaningful devaluation. The balance sheet of the Silicon Valley Bank at the end of 2022 is simplified in the bottom left corner of this slide. Banks are tightly regulated institutions and have very specific reserve and capital requirements, but some latitude is given to how they account for bond values on their balance sheets. This latitude may see some coming regulatory changes after this first quarter's events. But here's what happened. When banks purchase bonds, they have the option of accounting for bonds in two ways. The first is available for sale. These bonds must be valued at the current value they hold in the market. Pretty straightforward. The other bucket is that of hold to maturity securities. Because bonds have fixed future values, the regulators have not required them to mark those holdings to current values when calculating their reserves and capital requirements. However, if they need to sell those securities, then they'll need to mark all similar holdings to market values as well. And this is a big part of what happened to Silicon Valley Bank. As you can see, they had very small amount of securities in their very liquid buckets of cash and securities available for sale. The loans are relatively illiquid, and they couldn't sell their hold to maturity securities without marking down the value of their longer bonds in a dramatic fashion. As the crypto and tech companies that banked at Silicon Valley Bank began to draw down on their deposits, they ended up having to sell their hold to maturity securities and mark down a meaningful portion of their assets, breaching their reserve and capital requirements. The deposits then left very quickly, and the bank ended up insolvent. It's important to keep in mind that Silicon Valley Bank and Signature Bank were extreme scenarios compounded by their concentrated type of depositors, including crypto companies, venture capital, and tech companies. Looking at banks as a whole, in the chart on the left, we can see that Tier 1 capital as a percentage of risk-weighted assets is actually at a historically high level. Additionally, banks have been getting more conservative and have been tightening their lending standards in a meaningful way. So while we are concerned with the stock performance of many banks, we are not overly concerned with this being a financial crisis. Economically, the U.S. has continued to grow. After the first 2 quarters of negative growth in 2022, the U.S. has resumed its expansion with nice growth in the most recent 2 quarters. Consumer sentiment has moved off its low, but does remain at historically low levels. However, even though sentiment is low, consumers are continuing to spend. That spending level is a critical factor to watch as we move forward. The job market remains too strong, but is showing signs of movement in the right direction. And it does remain a concern for the Fed. Job openings have come down off their high, but remain well above historical levels. Job quits have begun declining, and layoffs have increased slightly. And while unemployment remains at record lows, wage growth has begun to slow, which is a positive from the Fed's perspective, but they are looking for it to slow further. Consumer spending remains elevated, which is good economically, but we are seeing some indicators that spending could slow in the future. Debt service ratios are rising, as are credit card debt levels. Following the excess savings seen through COVID, we are seeing personal saving rates at lower than average levels, and total consumer borrowing has also risen. None of these indicators are overly exciting on a positive or negative front, but are important to continue watching to see what might come next. From a domestic versus international standpoint, we have seen a change in leadership that hasn't occurred in nearly 15 years. Here, we see that the MSCI EFA, an international index, has outperformed the US index over the past year. This is an area where we have spent much time considering and believe much of this can be attributed to some earlier fears abating, specifically the Ukraine and Russia war, which has not escalated within other European countries, as well as the energy crisis in Europe that has been, for the most part, avoided by a mild winter and geopolitical dealings. While valuation levels are something to take note of, we are not seeing any meaningful changes economically that would drive us to move towards developed international markets. The US markets have rebounded in this first quarter and are showing signs that their desire is to move higher. Further, this desire seems to be focusing on the areas that were performing best prior to 2022 and the inflation problem. That said, they are also looking for data to substantiate whether or not inflation will soon be behind us. As such, we expect some continued volatility as that data proves to be positive or negative. Valuations have moved a bit higher to be slightly above their 25-year averages. This too implies a touch of optimism for economic growth and earnings going forward. After a decline in earnings for 2022, primarily as a result of increased costs due to inflation, 2023 and beyond is expected to resume its previous growth trajectory. Consider these charts. The right chart shows us the profit margin decline occurring last year, which is also seen in the chart on the left. However, consider the consensus of analysts' projections depicted in the blue bars. As you can see, there is an expectation of earnings growth going forward. And that expectation has in part resulted in a shift in style leadership with growth companies outperforming value companies this first quarter. It is important to note that within the growth style box, there was pretty meaningful dispersion in returns, and many of the companies that performed the best are also some of the companies that we believe still have meaningful risk. This sometimes occurs as market cycles shift, and it is our positioning that the quality companies with growth characteristics and reasonable values should look good moving forward. Currently, in our core equity model, we remain tilted towards growth. However, as I just mentioned, we are looking for very specific characteristics for companies within each of these style boxes. Our focus remains on GARP companies, companies who exhibit growth but are valued at a reasonable price. These could be companies that end up in the growth, blend, or value style boxes that show growth characteristics that aren't overly expensive, especially when it comes to valuation. We do expect some continued volatility ahead, and we find these companies to offer the most attractive risk-return ratio going forward. Lastly, in each of our equity strategies, we have been tactically using hedge strategies with the intention of dampening volatility. We have made some moves here over the past quarter and will continue to do so while we continue to expect some volatility. From a sector standpoint, our largest overweights are in technology, healthcare, consumer discretionaries, and energy. Our current underweights are in consumer staples, communication services, utilities, and real estate. Regarding energy, with the recent move by OPEC and other influencing factors around the world, we are maintaining our slight overweight exposure here. On a relative basis, for this first quarter, we have seen a shift in performance leadership from that of last year. The more value-oriented sectors have underperformed those of growth-oriented sectors. Whether or not this trend will continue will mostly depend on what happens with inflation, economic growth, consumer spending, and how businesses perform. While we do not believe we are out of the woods yet, there are signs of improvement. As economic and market conditions improve, you will continue to see some incremental shifts to position for the eventual recovery. Here, we consider our current weights within our core equity model. This quarter, we did make some moves to be slightly less defensive as economic indicators have shown some positive trends. That said, we do not believe we are in a risk-on market at the moment and remain thoughtfully positioned. One area that I would like to highlight on this slide is that of our technology and communication services weightings. These two sectors are highly correlated, and a few years ago, many of the communication service sector companies were actually considered technology companies. Companies like Google and Facebook are examples. Because of this correlation, we think it is important to look at them together when truly considering our level of over or underweight. At the end of last year, we had a market weight in technology and a meaningful underweight in communication services. These were two of the three worst performing sectors last year. We are currently at a 6.8% overweight in technology, the top performing sector this past quarter, but we are also about 3.7% underweight in communication services, for a net overweight of just over 3%. The reason for this comes down to our findings that more attractive companies reside in the technology space right now. We are currently in the process of making a few tweaks to each of our equity models, and we feel well positioned for what comes next. With the shift in style leadership this first quarter, and with much of that performance coming from what we believe to be riskier companies, the dividend model had some headwinds to fight. Remember, this strategy has an inherent tilt towards large cap value and the more value-oriented sectors, which has boded well for this model throughout 2022 and historically. This model has also focuses on underlying value companies with growth characteristics, which resulted in its stronger relative performance to other value companies in growth market cycles. Additionally, like the core equity model, We also continue to hold a defensive portion within this model to hedge strategies as well. Moving on to the bond side of things, with the most recent Fed fund rate hikes, we have seen a further inversion of the yield curve. Interestingly, while the Fed funds rate has risen, all other Treasury maturity yields have actually declined, resulting in some bond value appreciation. This does imply that the bond markets as a whole do not believe rates will rise higher and that they will begin declining further. Fed Chair Jerome Powell has been pretty clear that this is not their expectation, and only time will tell which is right. But let's look a bit closer at the market expectations. Here, we look at the Fed funds rate going back in time. As you can see, the current level of the Fed funds is certainly nothing unprecedented. Take a look at the blue diamonds. These are the Fed's year-end estimates for the future of Fed funds rates. It shows one more rate hike followed by rate cuts. The markets, on the other hand, depicted by green diamonds, show that they believe the next Fed action will be a rate cut. Time will tell, but it is interesting to note that both believe we are either at the top or quickly approaching it. And this appears to be the case for countries around the world. Consider the chart on the right. Each of these countries is telling a similar story. Another factor worthy of note is the central banks beginning to sell off parts of the bond purchases they made to stabilize the bond markets after COVID. This will increase the supply of bonds in the market and has the potential to add some pressure to bond prices. The one thing that all of these rate forecasts tell us is that we're getting much closer to knowing the answer as to whether or not the Fed will be successful in delivering a soft landing. Lastly, we wanted to reiterate our last couple years of positioning on bonds. Prior to the rising interest rate environment as a result of inflation, we had strong conviction in avoiding the part of the bond market with unrewarded interest rate risk. To that end, we had positioned with lower duration and thoughtfully structured bonds that were less interest rate sensitive. That move was rewarded as interest rates rose throughout 2022 and longer duration bond portfolios devalued. Equally important is our moves over the past several months in adding duration to our portfolios, effectively locking in these higher interest rates for longer periods of time. Given that we have been discussing this interest rate eventuality in our positioning for a couple of years now, we wanted to make sure to take a moment to reiterate that things have now changed. And recently, this has been an attractive opportunity within the bond markets to shift our exposures for the future. So in conclusion, given all available indicators and economic data, we continue to feel well positioned in each of our strategies. While it is likely we will continue to witness some volatility as we move forward, we feel strongly about the companies we currently own and the way we are positioned going forward. We remain focused on potential risk exposures and are prepared to reposition should indicators shift further one way or another. Know that we are watching the markets and your holdings incredibly closely. We are continuing to position your portfolios in efforts to reduce our perceived downside risk exposures with the intention of maximizing your risk-adjusted returns. As always, thank you for placing your trust in us, and please reach out to us if we can provide you with any additional information or clarity on the information presented. Take care, and we look forward to speaking with you soon.